In this section, we will discuss the risk-return trade-off and how to achieve optimal asset allocation based on your time horizon and risk tolerance. The risk-return trade-off is an investment principle that states that the higher the risk, the higher the potential reward. However, there is no simple formula that can find the right balance of risk and reward for every investor. It depends on various factors, such as your goals, your personality, and your situation. One of the most important factors is your time horizon, which is how long you plan to invest before you need the money. Generally speaking, the longer your time horizon, the more risk you can afford to take. This is because you have more time to recover from market fluctuations and benefit from long-term growth. For example, if you are saving for retirement that is 30 years away, you can invest more in stocks, which have higher returns but also higher volatility. On the other hand, if you are saving for a car that you want to buy next year, you should invest more in cash or bonds, which have lower returns but also lower risk. Another important factor is your risk tolerance, which is how comfortable you are with taking risk and facing losses. Risk tolerance is influenced by your personality, your emotions, and your financial situation. Some investors are more willing to accept higher levels of uncertainty and volatility in exchange for higher potential returns. Others are more conservative and prefer lower levels of risk and more stable returns. For example, if you are a risk-averse investor who gets anxious when your portfolio value drops, you should invest more in cash or bonds, which have lower risk but also lower returns. On the other hand, if you are a risk-seeking investor who enjoys taking calculated risks and chasing higher returns, you should invest more in stocks, which have higher risk but also higher returns. Asset allocation is the process of dividing your portfolio among different asset classes, such as stocks, bonds, and cash. The goal is to align your asset allocation with your risk tolerance and time horizon. By doing so, you can optimize your portfolio's performance and reduce its risk. There are different strategies for determining your asset allocation, such as strategic asset allocation, constant weighting asset allocation, and tactical asset allocation. We will not go into details of these strategies in this video, but you can learn more about them from other sources. The bottom line is that there is no one-size-fits-all solution for asset allocation. You need to consider your own goals, preferences, and circumstances when deciding how to divide your portfolio among different assets. You also need to review and adjust your asset allocation periodically to reflect any changes in your situation or the market conditions. By doing so, you can achieve optimal asset allocation and improve your chances of reaching your financial goals. One of the most important ways to protect your portfolio in a muted market is to diversify it across different asset classes. Asset classes are simply different types of investments, such as stocks, bonds, cash, international securities, emerging markets, REITs, etc. Each asset class has its own risk and return characteristics, and they tend to perform differently in different market conditions. By holding a variety of asset classes, you can reduce the overall volatility and risk of your portfolio, and increase your chances of achieving your investing goals. But how do you diversify your portfolio across asset classes? Here are some tips to help you. Understand your risk tolerance, time horizon, and investing objectives. These factors will help you determine how much of your portfolio you should allocate to each asset class. For example, if you are a young investor with a long-term horizon and a high risk tolerance, you may want to invest more in stocks and less in bonds. On the other hand, if you are an older investor with a short-term horizon and a low risk tolerance, you may want to invest more in bonds and less in stocks. Choose asset classes that have low or negative correlations to each other. Correlation measures how closely two asset classes move together. A positive correlation means they tend to move in the same direction, while a negative correlation means they tend to move in opposite directions. A low or negative correlation means they have little or no relation to each other. By choosing asset classes that have low or negative correlations to each other, you can reduce the impact of market fluctuations on your portfolio. Diversify within each asset class. Not only should you diversify across asset classes, but also within each asset class. For example, within the stock asset class, you can diversify by sector, industry, size, style, geography, etc. Within the bond asset class, you can diversify by maturity, credit quality, issuer type, etc. This way, you can avoid putting all your eggs in one basket and expose yourself to specific risks. Consider investing in ETFs or mutual funds. One of the easiest ways to diversify your portfolio across asset classes is to invest in exchange-traded funds, ETFs, or mutual funds that track different indexes or benchmarks. For example, you can invest in an ETF that tracks the S&P 500 index for exposure to U.S. large cap stocks, or an ETF that tracks the MSCI EAFE index for exposure to international developed markets. ETFs and mutual funds offer instant diversification at a low cost and with minimal effort. Rebalance your portfolio regularly. Over time, your portfolio may drift away from your original asset allocation due to market movements or changes in your personal circumstances. This may affect your risk and return profile and expose you to unwanted risks. To maintain your desired asset allocation and diversification level, you should rebalance your portfolio periodically by selling some of the assets that have increased in value and buying some of the assets that have decreased in value. By following these tips, you can diversify your portfolio across different asset classes and improve your chances of achieving your investing goals in a muted market. One way to diversify your portfolio in a muted market is to use index funds or bond funds. These are funds that track the performance of a specific market index, such as the S&P 500 or the Bloomberg Barclays U.S. Aggregate Bond Index. In this section, we will discuss some of the advantages and disadvantages of using these types of funds. Advantages of index funds and bond funds. Low cost. Index funds and bond funds are passively managed, meaning they do not require active trading or research by a fund manager. This reduces the fees and expenses that investors have to pay, compared to actively managed funds. For example, according to Morningstar, the average expense ratio for U.S. equity index funds was 0.08% in 2020, while the average expense ratio for U.S. equity actively managed funds was 0.66%. Lower fees can translate into higher returns over time. Diversification. Index funds and bond funds can provide exposure to a large number of securities across different sectors, industries, countries, and asset classes. This can reduce the risk of being overly concentrated in one area or affected by a single event. For example, an S&P 500 index fund holds 500 of the largest U.S. companies, representing about 80% of the U.S. stock market value. A bond fund can hold hundreds or thousands of bonds from different issuers, maturities, and credit ratings. Performance. Index funds and bond funds aim to match the performance of their underlying index, which can be a reliable benchmark for investors. Studies have shown that most actively managed funds fail to beat their index over the long term, after accounting for fees and taxes. For example, according to Spiva U.S. scorecard, only 23% of U.S. equity actively managed funds outperformed their index over the 10-year period ending December 31st. Disadvantages of index funds and bond funds. Lack of control. Index funds and bond funds follow a predetermined set of rules to select and weight their holdings, based on their index methodology. This means that investors have no say in what securities are included or excluded from the fund, or how they are allocated. For example, an S&P 500 index fund will always hold the same 500 companies as long as they meet the index criteria, regardless of their valuation, growth prospects, or environmental, social, and governance (ESG) factors. Lack of flexibility. Index funds and bond funds are designed to track their index as closely as possible, which can limit their ability to adapt to changing market conditions or take advantage of opportunities. For example, An index fund cannot sell an overvalued stock or buy an undervalued one, unless the index does so first. A bond fund cannot adjust its duration or credit quality to hedge against interest rate or default risk, unless the index does so first. Tracking error. Index funds and bond funds may not perfectly replicate their index performance due to various factors, such as fees, expenses, trading costs, sampling errors, rebalancing frequency, cash holdings, and dividend reinvestment. This can result in a difference between the fund's return and the index's return, known as tracking error. Tracking error can be positive or negative, depending on whether the fund outperforms or underperforms its index. For example, according to Morningstar, the average tracking error for U.S. equity index funds was 0.22%. In summary, index funds and bond funds can offer low-cost diversification and performance that matches their index over time. However, they also have some drawbacks, such as lack of control, lack of flexibility, and tracking error. Investors should weigh these pros and cons carefully before deciding whether to use these types of funds to diversify their portfolio in a muted market.